Welcome to our series of videos on the income statement. The income statement is sometimes referred to as the statement of operations, the statement of earnings, and sometimes referred to as the profit and loss statement. Now, the income statement is unlike the balance sheet. In a prior video, we said the balance sheet measures assets, liabilities, and equity on a single day, on December 31st. The income statement, on the other hand, measures things over time. So when we say the income statement has a date of December 31st, what we're saying is the income statement contains information about sales, expenses, gains, losses over a 1-year period. So from January 1st through December 31st. So why is this income statement so important? Well, the income statement often serves as an input to valuation. So when an analyst is trying to make a recommendation about whether or not an investor should buy or sell stock, oftentimes the first stop in the analysis is to go to the income statement, to look at revenues, to look at expenses and gains and losses. All right, so the income statement is an input to valuation. And there is a formula for the income statement. The formula is as follows. Net income, which is sometimes referred to as the bottom line, is equal to revenues minus expenses plus gains minus losses. And let's start by talking about each of these components by looking at revenue specifically. What is revenue? Well, revenue represents sales made to customers, whether or not we're a retailer, a manufacturer, or a service company. It represents sales made to customers. And the number that you see reported as revenue actually represents what I would refer to as net revenue. What is net revenue? Well, net revenue is sales made to customers reduced by estimates of returns and discounts taken by customers. So revenue less returns and discounts. The number that you see in a typical company's income statement is net revenue. All right, let's talk next about expenses. So revenues, broadly speaking, are inflows of economic resources to the company, and expenses are outflows of economic resources. Things like cost of products sold, research and development costs. These are all outflows of resources from the company. And these outflows of resources, these expenses, they can be grouped either by their function or their nature. And let me give you some examples. An expense that's grouped by function is cost of goods sold. Cost of goods sold groups together material costs, labor costs, and overhead costs. Even though these individual costs are very different from one another, they are grouped together because they have a common function. And these costs, the common function here is to develop a product or develop a service or deliver a service. All right? So cost of goods sold is an example of grouping expenses by function. Now, depreciation is an example of grouping expenses by nature. We're grouping together the reduction in value of assets, long-term assets, regardless of what the asset is. All right, so we could group expenses by function and nature. Now, if you take revenue in the income statement and you subtract from it cost of goods sold, you'll get a subtotal called gross profit. All right, and then if you take that gross profit number and subtract from it operating expenses, things like research and development costs, selling, general, and administrative expenses, you get a second subtotal referred to as operating income. So these are two very important subtotals between revenue and net income, and they are gross profit and operating income. So you will see subtotals and totals in the income statement. And each of these is informative for analysts. Now, I should mention here that operating income is often the same as earnings before interest and tax, a finance concept, EBIT, right? It's often the same as EBIT, but not always. So I want to caution you there that operating income is not always the same as EBIT. Now, let's conclude here by talking about gains and losses. What are gains and losses? Well, gains and losses are inflows and outflows of resources from the company or to the company that are unrelated to its main business. So for example, if we have an auto manufacturer that happens to own a piece of real estate and the auto manufacturer decides to sell that piece of real estate, that would be considered a gain or loss depending on the specifics of the transaction. It's not part of the main business of the auto manufacturer. The auto manufacturer is not in the business of selling real estate, and so we're treating this separately from the main business. In this video, we discussed the income statement. In the next videos, we'll take a deeper look at each of the components of the income statement. Thank you for watching. I'll see you very soon. Take care.